WISE is down 20% from its highs. A money laundering investigation across 30 European countries. A US banking license just rejected over compliance failures. And a revenue model where a third of income could vanish if interest rates fall. At £9.33, WISE looks cheap. 17 times trailing earnings for a company growing revenue at 25%. But is that cheapness justified? Or is the market missing something? Let's break it down. Before we build the bull case, here's what's keeping me up at night. First, the investigation. In June 2026, the Bureau of Investigative Journalism reported that WISE platforms were linked to approximately £432 million in suspicious transactions across 30 European countries. Belgian prosecutors are actively investigating, including drug trafficking connections. We don't know where this ends. Second, the US trust bank rejection. In July 2026, the Office of the Comptroller of the Currency denied WISE's application for a national trust bank charter. The reason? Long-standing deficiencies in anti-money laundering compliance. This isn't just a journalist's report anymore. A US federal regulator has formally documented compliance failures. That trust charter would have given WISE direct access to the Federal Reserve's payment system, which was key to cutting costs in the US. Third, interest rate dependency. Roughly 30 to 35% of WISE's revenue comes from interest earned on customer deposits. Now over $41 billion sitting in accounts. If central banks cut rates aggressively, that income stream shrinks fast. Fourth, the CEO's governance history. Christo Kehrmann had a deliberate tax default of £720,000 flagged by the Financial Conduct Authority in 2022. And the OCC cited management quality concerns in its rejection. Fifth, competition is heating up. Revolut now has over 70 million customers and its own banking license. Atlantic Money is offering fixed-fee transfers. Even traditional banks are finally improving their cross-border pricing. I'm Alex, and this is Probable Alpha, where we use probability-weighted models to cut through the noise and find asymmetric opportunities. So what does WISE actually do? WISE is the world's largest independent cross-border money transfer platform. Founded in 2011 by two Estonians frustrated with bank fees, the company has grown to serve nearly 12 million active customers across over 160 countries. The original insight was simple. Banks charge 5% or more on international transfers, mostly hidden in the exchange rate markup. WISE built infrastructure to route money locally on both ends, avoiding the traditional correspondent banking system entirely. In its most recent quarter, WISE processed over $69 billion in cross-border volume, up 26% year over year. And 77% of those transfers now arrive instantly. But it's evolved well beyond simple transfers. WISE Account gives customers multi-currency balances in over 40 currencies, with local bank details in 10 countries. WISE Business serves small and medium enterprises with multi-currency treasury management. And WISE Platform lets banks and fintechs embed WISE's payment rails directly into their own products through an API. As of May 2026, WISE's primary listing moved to NASDAQ under the ticker WSE, with the London Stock Exchange becoming a secondary listing. WISE's moat is built on 3 pillars. First, cost advantage through scale. WISE's peer-to-peer matching engine routes money locally wherever possible, avoiding expensive correspondent banking fees. The more users in each currency corridor, the more efficient the matching, and the lower the cost per transaction. This is a genuine network effect, and it compounds with scale. Second, regulatory infrastructure. WISE holds licenses in over 40 jurisdictions. Building this regulatory footprint from scratch would take years and hundreds of millions in investment. It's a barrier that Revolut is crossing, but most challengers can't. Third, the deliberate pricing strategy. WISE's stated mission is to make international money transfers free. They've been systematically reducing their take rate, the percentage they charge per transaction, which just hit an all-time low of 0.5%. This sounds like margin suicide, but it's actually a growth strategy. Each price cut drives more volume, which drives more scale, which reduces unit costs, which funds the next price cut. It's the Amazon playbook applied to payments. The risk, of course, is that competitors skip the journey and just start at the low price point. That's exactly what Atlantic Money is doing with fixed fee transfers. This is the slide that matters most for understanding WISE. Revenue comes from 3 distinct streams, and they have very different characteristics. Stream 1, transaction revenue, about 55 to 60% of total revenue. This is the core business, the percentage WISE takes on each cross-border transfer. In the most recent quarter, transaction revenue grew 27% year over year. It's growing with volume, it's sustainable, and it's within management's control. This is what you're really buying when you invest in WISE. Stream 2, interest income on customer float, about 30 to 35% of revenue. WISE holds approximately $41 billion in customer deposits, up 31% year over year. At current interest rates, that generates substantial income. But this is not a competitive advantage. It's a function of the rate environment. If rates fall 200 basis points, this stream could decline by 40 to 50%. The market knows this, and it's a key reason the stock is cheaper than the growth rate suggests. The silver lining: the float balance is growing so fast that even with rate cuts, the absolute income may be more resilient than feared. Stream 3, other revenue, about 10%. WISE platform API fees, card transaction fees, and subscription products. Small today, but growing fast and high margin. Understanding this split is essential because the headline revenue growth of 25% masks a critical question. How much of that growth is sustainable transaction revenue versus rate-sensitive float income? Now let's look at the numbers. In its most recent full year, ending March 2026, WISE reported net revenue of $2.5 billion, up 19% year over year. Income before tax hit $660 million, giving a margin of 26%. But the real story is the acceleration. In the first quarter of financial year 2027, revenue jumped 25%, a meaningful step up from the full year pace. Cross-border volumes hit $69 billion, up 26%. Active customers reached nearly 12 million, up 21%. And customer holdings surged to over $41 billion, up 31%. Importantly, capital expenditure remains minimal. This is a software business, not a capital-intensive one. The balance sheet is clean with no significant debt. The company has no need for external financing. And for the first time, management announced a $500 million share buyback program, signaling confidence in the valuation. Market cap is approximately £9.2 billion, around 9,000 employees. The stock is 20% below its 52-week high. When a stock falls that far, our framework requires a formal dislocation audit. We identify every catalyst driving the decline and trace each one to specific scenarios in our model. We identified 7 catalysts. 1. The anti-money laundering investigation, structural risk, traced to our bear and tail scenarios. 2. The OCC trust bank license rejection, structural, traced to bear and tail as a pattern of regulatory failure. 3. Interest rate sensitivity, cyclical risk traced to all scenarios. 4. The transition to NASDAQ, now resolved, primary listing completed in May. 5. US regulatory fines, a $2.5 million CFPB fine plus a $4.2 million settlement with 6 states over AML compliance gaps. 6. Intensifying competition from Revolut and traditional banks. 7. The CEO's governance history. Every single catalyst is accounted for in our scenario model. Nothing is being ignored. Let's build the model. We model 5 scenarios over a 5-year horizon from the current price of £9.33. Each scenario has a narrative, a terminal value, and a probability weight. We present the scenarios first, then assign probabilities separately using independent signal categories. Let's walk through each one. The bull case. Cross-border volume growth sustains above 20% annually as WISE captures share from banks across new corridors, particularly India, Latin America, and Africa. WISE platform scales with 10 or more Tier 1 bank partnerships, becoming the infrastructure layer for global payments. The anti-money laundering investigation resolves cleanly with a modest fine. WISE successfully reapplies for a US trust charter under the Genius Act, eventually gaining direct access to the Federal Reserve's payment system. Customer holdings grow to over $80 billion, providing substantial interest income even as rates decline. The NASDAQ listing drives a re-rating to US fintech multiples. The $500 million buyback reduces the share count meaningfully. Revenue reaches $5.2 billion by financial year 2030. Net margins expand to 27%. Earnings per share of £1.42 at 28 times gives a target price of £39.83. That's a 33.7% annualized return. The optimistic base case. Volume growth sustains at 15%. WISE platform contributes meaningfully but doesn't transform the business. Moderate rate cuts reduce interest income by 25 to 30% from peak, partially offset by float balance growth. The Genius Act reapplication stalls or delivers limited US benefits. The investigation results in a fine of £1 to £200 million, but no structural impact. Competition from Revolut creates pricing pressure, but WISE retains its cost advantage. Revenue reaches $4.2 billion. Net margins of 25%. Earnings per share of £1.06 at 23 times gives £24.47. That's 21.3% annualized. The standard base case. Growth decelerates to about 10% as the cross-border market matures in developed economies. Interest rates fall materially, cutting float income by 40 to 50%. The investigation results in a £2 to £400 million fine plus ongoing elevated compliance costs. Revolut and banks narrow WISE's pricing gap. Revenue reaches $3.4 billion. Margins compress to 22%. Earnings per share of 76 pence at 18 times gives £13.64. That's 7.9% annualized. The bear case. Volume growth stalls at 5% as traditional banks match WISE's pricing using real-time payment rails. Revolut takes meaningful market share with its broader product suite. Rate cuts crater interest income by 80% or more. The OCC rejection proves symptomatic of broader regulatory pushback. The investigation leads to significant penalties of £500 million or more, plus restrictions from banking partners. The take rate is forced below 0.4%. Revenue barely grows to $2.3 billion. Margins collapse to 13%. Earnings per share of 30 pence at 12 times gives £3.64. That's negative 17.2% annualized. The tail risk. The anti-money laundering investigation leads to license revocations in key European markets. The OCC rejection is the first domino. Multiple jurisdictions follow with regulatory action. Banking partners sever relationships. Customers flee as trust collapses. Law firm investigations escalate to formal class actions. This combines with severe rate cuts and technology disruption, stablecoins, and government-sponsored payment rails gaining real cross-border traction. Revenue declines to $1.2 billion. Margins collapse to 5%. Earnings per share of just 6 pence at 6 times gives 36 pence. That's negative 47.8% annualized. Near total destruction of value. Now let's assign probabilities. We build a mosaic from independent signal categories, starting with growth momentum. And this is where it gets interesting. WISE's most recent quarter showed revenue growth of 25%. an acceleration from the full-year pace of 19%. Cross-border volumes grew 26%. Customer holdings surged 31%. This isn't a company that's slowing down. It's speeding up. This tilts toward the optimistic base and bull scenarios. Interest rate environment. Central banks appear to be in a cutting cycle, but the pace is uncertain. Here's the key update. Customer holdings are now over $41 billion, growing 31% annually. That float growth provides a meaningful buffer. Even if rates fall 200 basis points, a much larger pool at a lower rate can still generate substantial income. This partially mitigates the bear case interest income risk, though it remains a headwind. Regulatory signals. This is where it gets concerning. We now have 2 independent regulatory data points confirming compliance concerns. The Belgian investigation is ongoing, and a US federal regulator, the OCC, has formally documented long-standing AML deficiencies. Add the $4.2 million state settlement in 2025, and you have a pattern across multiple jurisdictions. This pushes tail risk from our standard 3 to 5% up to 9%. The OCC rejection doesn't just block a US growth avenue, it validates the concerns that the Belgian investigation raised. Competitive dynamics. Revolut is a genuine threat but operates a different business model. It's a super app, not a pure-play cross-border specialist. WISE.L's cost advantage at scale remains real. Traditional banks are improving, but slowly. Neutral signal. Technology disruption. Stablecoins, central bank digital currencies, and government-sponsored real-time rails could structurally reduce demand for private cross-border intermediaries. Notably, WISE may be exploring stablecoin technology as part of its Genius Act reapplication. This is a 5 to 10-year risk, or potentially an opportunity if WISE adapts. Putting it together, bull 16%, optimistic base 30%, standard base 26%, bear 19%, tail 9%. The probability-weighted geometric compounded annualized growth rate comes out to 14%. Now the question, does 14% clear the bar? Every stock needs to earn more than a personalised hurdle rate. The minimum return that compensates you for the specific risks of holding that stock versus risk-free government bonds. For WISE, we start with the risk-free rate, the UK 10-year gilt yield of 4.95%. Next, a variance-scaled equity risk premium. We take WISE's scenario implied standard deviation of 24%, divide by the broad market's 15.5%, and multiply by the market equity risk premium of 4.72%. That gives us 7.3%. This is higher than the flat market premium because WISE's outcome distribution is wider than average, reflecting the regulatory uncertainty, the AML investigation, the OCC rejection, and the binary nature of those risks. Then, a small revenue-weighted country risk premium of just 0.07%. WISE earns 95% of revenue from developed markets. Adding it up, 4.95 plus 7.3 plus 0.07 gives us a personalised hurdle of 12.3%. Our compounded annualized growth rate of 14% clears that hurdle by 1.7%. That's a positive spread, but a thin one. But we need to stress test this. Our framework requires a macro stress test. What happens if we're wrong about rates and multiples? We raise the risk-free rate by 150 basis points to 6.45%, and we compress all terminal multiples by 15%, simulating a sustained higher-for-longer environment with a broad D-rating. Under stress, the expected return falls to 10.4%. The stressed hurdle rises to 13.8%. The stressed spread is negative 3.4%. This means our verdict does not survive the macro stress test. In a world where rates stay higher for longer and multiples compress, WISE falls well short of its hurdle. This is why we cap the verdict at low conviction buy rather than a full buy. The thesis works in the base case but breaks under adverse macro conditions, and breaks significantly. To be fair, here's the case that our model is too conservative. First, the float growth story. Customer holdings are growing at 31% per year. Even if rates fall 200 basis points, a $40 billion pool growing at that pace could maintain, or even grow, absolute interest income. The rate sensitivity may be less dangerous than the market thinks. Second, the AML investigation may still resolve quickly. WISE has cooperated with regulators historically and holds licenses in 40-plus jurisdictions. The OCC rejection was about a new charter application, not about revoking existing licenses. A negotiated settlement on the Belgian investigation with a moderate fine remains the most likely outcome. Third, the NASDAQ listing is already delivering value. WISE now trades on the same exchange as PayPal, Block, and other US fintechs. US institutional access is improving. Fourth, WISE platform is underappreciated. If major banks continue to embed WISE's rails into their own products, the platform revenue could grow from 10% to 25% of the total. And it's high margin, recurring, and not rate sensitive. Fifth, the $500 million buyback. This is management putting their money where their mouth is. It's the first major capital return in WISE's history, and it signals that management believes the stock is undervalued at these levels. Risks to monitor. The anti-money laundering investigation. This remains the existential risk. Any regulatory action restricting WISE's ability to operate in a major market would fundamentally alter the thesis. Reassess immediately upon any outcome. The OCC rejection aftermath. Monitor whether this triggers further regulatory scrutiny from other jurisdictions. If banking partners begin restricting access to payment rails, the bear case accelerates. Interest rate trajectory. Watch central bank guidance closely. A faster than expected cutting cycle would compress the highest quality revenue stream, though float growth provides some buffer. Competitive pricing. Monitor Revolut's cross-border pricing and traditional bank FX margins. If the pricing gap narrows to less than 50 basis points, WISE's value proposition weakens materially. Law firm investigations. Currently, no formal class action has been filed, but monitor for escalation. A securities fraud suit with material exposure would be a new negative catalyst. Technology disruption. Track stablecoin cross-border volumes. If they exceed 5% of traditional corridor volumes, the long-term structural thesis changes. And the Genius Act reapplication, the outcome will determine whether WISE can access the US Federal Reserve payment system. This could be a significant positive or confirm the US regulatory headwind. Here's how the math works at different prices. At £9.33, where we are today, the spread is plus 1.7%. That's a buy, but a thin one. At £8.46, the spread reaches 4%, strong buy territory. At £7.76, the spread hits 6%, high conviction buy. Below that, you're getting genuinely exceptional risk-reward on a company growing 25%. On the other side, our exit target is £10.7. At that price, the forward spread compresses to near zero. The expected return no longer compensates for the risks. If WISE hits £10.7, reassess rather than hold blindly. The 52-week range is £7.54 to £11.64. These entry and exit levels are well within the recent trading range. The verdict. At £9.33, WISE is a low conviction buy. The expected compounded annualized growth rate of 14% clears our 12.3% personalised hurdle by a spread of plus 1.7%. That's a positive spread, but a thin one. The conviction is capped at low for 3 reasons. 1. The thesis is macro-fragile. Under stress test conditions, rates higher for longer, multiples compressing, the spread turns deeply negative at minus 3.4%. 2. The pessimistic end of our confidence range shows a negative 2.5% spread, meaning adverse but plausible assumptions flip the verdict entirely. 3. The regulatory picture has gotten worse, not better. We now have two independent data points: the Belgian AML investigation and the OCC Trust Bank rejection, confirming compliance concerns. The 9% tail probability reflects this. But here's what's working in WISE's favour: 25% revenue growth and accelerating. Customer holdings growing 31%, providing an interest rate buffer. The first ever share buyback showing management confidence, a genuine network effect moat in cross-border payments, and a stock trading at just 17 times trailing earnings for a compounder with these characteristics. The exit target is £10.7. Stronger entries exist at 8.46 and 7.76. Watch the investigation outcome and the Genius Act reapplication. Those two events will determine whether this moves to buy or to pass. As always, this is analysis, not a financial recommendation. Do your own thorough due diligence before deploying any capital. All investments carry risk, including the potential loss of your entire principal. If you found this analysis useful, hit subscribe and like for more probability-weighted investment breakdowns. See you in the next one.